Welcome to West Michigan Philanthropy. I'm John McFarland with Miller Johnson's Trust and Estates Practice Group. I'm joined today by Jamie Kuiper with the National Christian Foundation of Michigan, and Dan Poortenga, Vice President with National Christian Foundation. Dan, I have to plug our West Michigan Planned Giving Group as well. I'm the president of that organization, and Dan is the vice president. He'll be the incoming president for 2024. So we like to get together and talk about topics related to planned giving. Today, we're going to talk about donor advised funds. And my guests today are two great contributors to West Michigan in that arena. And Miller Johnson does a lot of work with the National Christian Foundation. And we have mutual clients and donors that like to take advantage of some of the opportunities that are available with donor advised funds. In general, Jamie and Dan, donor advised funds give a taxpayer donor client the opportunity to make a charitable gift, an irrevocable gift to the fund. And one of the nice things, I think, at least from my perspective with my clients, is when you do it, you don't have to automatically know at that time who the ultimate recipients of the grants will be from that donor advised fund. So say you give $100,000 to a donor advised fund, the client donor may not know they want to give to recommend grants to any particular charity. It's an irrevocable gift. They get the tax deduction availability for the $100,000 up front, and then they make grant recommendations to the administrator of the DAF, and then you would follow through and make those grants out to those recommended recipients. I think that's important to convey to taxpayers, clients, donors that it is irrevocable. They have that opportunity to make those recommendations, but there has to be that clear line so they can obtain that charitable income tax deduction. Do you have a database? How do you work with your donors when screening potential grant recipients? Do you have a database that you work through in terms of due diligence to make sure they're a qualified public charity or a recipient of a DAF grant?
We do have an existing database of charities that have already been approved to receive grants, and any charity that's been approved to receive grants from NCF is reapproved every 15 months. That's our internal practice, is to refresh our data on those. Our process, though, is if a charity is not already approved in our system, once we have a grant recommendation to that charity, it immediately kicks off that process for us. So for NCF, there's a couple layers to that. One is we need to make sure they're tax exempt. And so that part of the screen is related to what the IRS requires of us. And then NCF is an affinity group of Christian givers and holds to a kind of a Christian worldview. And so there's an additional screen there that just looks at the activities of the charity to make sure it's consistent with our value system. So there's ongoing conversation between us and givers, sometimes around the charities they support. We want to make sure that we're a good fit for them and they're a good fit for us. But yeah, it will approve any new charity as soon as somebody wants to support it. We initiate the process.
That's helpful for donors. Go ahead, Dan.
And John, there's we have a lot of charities in our system. I think in 2022, donors granted about $2.1 billion with a B to over 31,000 charities.
Oh my goodness. That's an amazing component to the giving in this country. And it's a quiet form of giving, and you don't hear those numbers and those statistics, but there's so much good being done here in West Michigan, across the country, by families that are utilizing these donor advised funds. Do you have, when you have donors come to you, I imagine you get this question a lot. They'll say that they might be in between a private foundation or a donor advised fund. I get that question a lot from clients. And I always try to encourage them, if I can, to take a hard look at the donor advised fund because of the tax advantages and the administrative ease of the donor advised fund. I think that's something that people hear private foundation, which private foundations are fantastic. They're great vehicles, and families, I think, can work in a great way to do a lot of good through private foundations. But there are some tremendous advantages to the donor advised funds. The deductibility ceilings is one area where I think is a tremendous advantage. You are treated, in essence, as having public charity status. Is that not the case?
Yes, that's right. Yep.
So you get 60% of the AGI deductibility ceiling for cash gifts, and then 30% for marketable securities held long term, whereas opposed to the private foundation gifts, they are limited to the 30% for cash and then 20% for the marketable securities held long term. So there's an advantage I see in terms of your dollars and the bang for your buck in terms of the charitable deduction benefit available to your donors. The private foundation rules is another area where I think that they could be a bit onerous, and if you're not ready for that challenge and ready to pay the costs associated with administering those the private foundations and dealing with those different rules, that could be a little bit of a challenge, I think, for taxpayers' clients if they're not ready for that. The DAF process is pretty simple, isn't it?
Yeah, in terms of setting it up administratively, it's very simple. You're not creating a new entity, so there's no additional tax returns that need to be filed. It's a lot more analogous to opening an online bank account than it is, starting a new business. And certainly, if you're creating a private foundation, as you know, you're creating a brand new entity and everything that comes along with that. But I think you're exactly right in terms of some of these key distinctions. The tax treatment is different, materially different. There is that broader deductibility, and as you know, John, very significantly for a lot of higher net worth families, while the barrier of setting up a private foundation from a financial standpoint might not be that big of a deal for them. They're well off; they can easily afford that. The odds are they made a bunch of their money in a closely held business or real estate. And those are not great gifts to a private foundation. Even if you're working below that 20% capital asset threshold, you get a basis deduction for contributions of those assets to a private foundation. Public charities, we get fair market value deductions for contributions of those closely held assets. And so that's another really key distinction in the tax treatment, particularly if we're working with somebody who's amassed a considerable amount of wealth in the form of real estate or closely held businesses. Those can be really, really powerful charitable gifts, but you need the right toolbox.
Well, and we saw that. I think probably the most famous example was with Paul Newman's own foundation, where he wanted to give a business and have the profits go on to support charitable efforts. And then I think that he found out the hard way, unfortunately, his family, that really it wasn't permissible in prior versions of the law. They had to actually lobby and get a provision passed to allow for that, so they could go on and do that. But it does, in the private foundation context, create some complications. And I know that a lot of, at least my experience with the National Christian Foundation, which I really appreciate, is you take on some of those harder assets, what we call the complex assets, the closely held businesses, the real estate, some of the assets that are a little bit trickier to deal with from a charitable standpoint, from a tax standpoint. And a lot of charities that I have dealt with aren't willing to go down that route because of the complexity. You deal with S Corp entities, closely held businesses, LLCs. Tell me a little bit about your experience dealing with some of those assets and how you are able to tackle those in a way that maybe some other organizations aren't willing to do?
Recently, a couple of brothers wanted to support a school building project, and their wealth was in real estate holdings that they had owned for a long time, and they offered the school a $3 million industrial building that they owned and said, you can have this. And it had an industrial tenant, and it was managed by a property management company. And the school said, well, we can't take a industrial building. We wouldn't know what to do with that. Why don't you just sell it? And then you can make a gift to us out of the proceeds. And the realtor who they were, the individual they were dealing with referred them to the National Christian Foundation. And we, in those situations, do a comparison and just see what it would look like if they were to sell the building, pay the taxes, and then make a contribution to the net proceeds versus giving the building to the National Christian Foundation, taking a fair market value deduction, and then we can turn around and sell it. We may not pay as many taxes or maybe none. And then the proceeds can go to the school, and it made a significant difference. The school received significantly more, and the brothers received a larger tax deduction.
That has been my experience working with you. A lot of times I've come across charities that just don't have the resources, the know-how, the plan giving background, tax background to kind of tackle some of those more challenging issues. And you really, excuse me, provide a tremendous service here in West Michigan by, in essence, helping the donor, helping the charity that's going to be the grant recipient, and kind of navigate and work through some of those thornier issues. Do you, it's apart from the donor advised fund, I know not directly with you two, but I know I've worked with National Christian Foundation on some charitable gift annuity programs. You have a charitable gift annuity program. Is it through your Atlanta office that you do that?
Yeah, pretty much all of this is resourced out of Atlanta. We're an affiliate group. There's 30 offices around the country, and we share some of those technical resources out of our central office in Atlanta. But we do provide charitable gift annuities. There's a number of charities here locally and nationally that use us for those, and can look a couple of different ways. I mean, certainly a lot of charities don't have enough demand for annuities to create a sufficient pool to make it safe to be in the annuity business. The last thing you want is one big annuity for a guy who lives to be 110 years old. That can create some real problems. And ironically enough, the more charitable you are, there's some studies that show the likely you are to become that old guy. So
it's good for the old guy, maybe not so good for the charity holding the contract.
That's exactly right. That's exactly right. And so, you know, NCF operates in the aggregate. And so we can have a charity can set up a single charity fund with NCF that is only for the benefit of that charity. And then we'll provide the annuity. We'll facilitate the annuity, administer it, and then the charitable proceeds go into the single charity fund for the benefit of that charity. And so they can be confident that it's going to go to them. It can only go to them. But we handle the administrative load on that. The other way it can be done is if a giver wants to set up maybe a significant annuity that benefits multiple charities, in which case they could name their donor advised fund as the beneficiary of that annuity, with the charitable proceeds then being divided up however they see fit among several charities. And, you know, to the plan giving officers, to the charities who would be listening in on this, I think that's one of the key things. It's just, I'm sure it's been your experience too, John. If you're working with somebody who's a really charitable person, generally speaking, there's more than one charity on their list of organizations they want to care for. And especially when you get into the realm of these complex assets, sometimes even a big annuity, the donor's heart is to support multiple causes, which when you're working with complex assets makes it almost impossible, you know, to think about having maybe 3 or 5 charities own part of your company for a little while, or become partners in a real estate enterprise. And that's where a donor advice fund can become really significantly helpful is we can be that single source of holding on to this complex asset, facilitating the more complicated transactional side of the gift in a manner that allows them to support multiple charities. And that just grosses up the leverage of the strategy, rather than giving maybe $100,000 worth of my real estate, I can give $500,000 worth of my real estate, knowing I can support all of my causes with it. And from the donor's perspective, it just usually means that much more for them and their family to plan with, and that much more at the end of the day that they'll have to support all of those causes.
It simplifies the process. And I know from experience, some of those charities will just flat out turn down some of those gifts, which is unfortunate because they can benefit from them. But again, it's the resources, the staff, the ability to tackle some of those tougher gifts that really, I think that's where the DAFs, National Christian Foundation, provides a tremendous service for community members and donors that want to do that and streamline the process as you described, make it a little bit easier. For your gift annuity program, do you take assets other than cash or marketable securities? Will you take a piece of real estate? I know a lot of charities won't do that, or if they do it, they'll do it on a limited basis.
We can, yes, and we have. I've done a few of them over the years. You have to be a little careful with those. Sometimes they'll usually end up having to be a deferred annuity. We got to give ourselves some time to sell it. From the charity standpoint, in that case, we're committing to make regular payments to this person for the rest of their life, and we're taking in an illiquid asset in order to do it. There's quite a bit of risk on the face of it that goes with that. We can plan our way around some of that risk, and I'd say probably a third of the time it ends up making sense. And we're able to put something together that's useful and valuable to everybody. And probably a little more than half the time you look at it and it ends up being more complicated than it's worth. But those are conversations we're happy to have. And so to those charities who are inclined to say no because it's too complex, we just say, well, it's just one extra phone call. At least give us a run at it. In worst case scenario, it's a no. We don't charge anything for the phone call, no harm done. But for those instances where it does make sense, it usually makes a bunch of sense, and it's adding tens of thousands or hundreds of thousands of dollars of value, and a lot of that value is accruing to the benefit of the causes these folks support.
I've seen the charitable gift annuities funded with farmland sometimes because the charities will know that it's usually pretty hot farmland that they know is going to sell. So they'll do the environmental assessments and due diligence looking for things. There's always things like underground storage tanks or contamination of some type. But if you can get past that hurdle and that the property is going to sell and it's a good market, that I've seen that done again with the deferred charitable gift annuity to give the charity a little bit of time to deal with the sale and the illiquid asset. In that context, do you handle charitable remainder trusts? Is that something that you would be willing to serve as a trustee of a charitable remainder trust, or is it just the gift annuities and the donor advised funds for your organization?
Just the gift annuities and donor advised funds. We don't do trustee work. Okay. We are pretty routinely named as the beneficiary of a charitable remainder trust. Again, for the purpose of being able to then spread that out among multiple charities so that the remainder trust accrues to the benefit of their donor advised fund. And then we are given instructions when this thing matures, here's the list of charities we want to be supported with it. And it's been interesting to me particularly over the last several years. We've had a few donors that we work with who did that, got a ways down the road and got to a point in life where now they realize they don't need the remainder trust anymore. The income it was protecting no longer is necessary. And they've started to accelerate pieces of that charitable remainder and take meaningful deductions for those contributions for that accelerated portion and in activating that long-term charitable intent now during their lifetime. and slowly kind of wind those CRTs down, which gets the charities the money faster, gets them deductions during their lifetime when they're valuable. And I think significantly for the donor, gives them the opportunity to participate in those gifts while they're alive and see the good that it's going to do.
I think that the one key issue that we see as planners when we're dealing with clients, with these estate tax exclusions so high now, it's 12.92 million now with this inflation adjustment for 2023. That's high. I remember when I started as a young associate in Chicago, it was $675,000. And I remember people writing some big checks. And I remember seeing for the first time in my life, someone write a check where the number didn't fit on the check in the little box there. And I recall that hit a lot of people. I mean, if you had an IRA, a home, life insurance, you could creep over that amount pretty easily. Now, most taxpayers are not going to be dealing with estate tax. It does sunset in 2025. And so if Congress doesn't act, and so it goes back down to $5 million index for inflation. So for a married couple, you have twice that amount. Right now, twice of 12.92 million. That's a lot of money, a lot of room. So we are seeing more of a focus on the income tax planning. And that's where I think that the lifetime gifts, the plan gifts, where there is that income tax deduction available is becoming very, very popular, and people are really zeroing in on that. That's where I think the donor advised funds and the gift annuities are really popular now. The Secure Act 2.0 is interesting too. We talked about this in our last segment of West Michigan Philanthropy. There is the opportunity to make for individuals who are 70 and a half years or older to make gifts from their IRA, and now that Secure 2.0 Act allows for the one-time election of $50,000 annually to be the one time to be used for a split interest vehicle like a charitable gift annuity. So you might see some more activity there with NCF, with the charitable gift annuities from those QCDs.
I think we probably will. And I'd say to the charities listening in, again, if you don't have a charitable gift annuity program and it feels risky to create one, which it probably should feel risky to create one, starting small is tough with annuities. You could establish a single charity fund with National Christian Foundation, and we can then facilitate those $50,000 charitable gift annuities for the benefit of their organization. Now, a donor advised fund cannot be the beneficiary of one of those gift annuities because it's related to a qualified charitable distribution. That's and right. Just like the QCD itself can't go to a donor advised fund, neither can a gift annuity.
That's a good point. Thank you for pointing that out. That is. Do you have a separate entity?
Oh, we have a single charity fund. It's different than a donor advised fund. It meets the requirements under the Secure Act and is eligible as a recipient. So we would certainly encourage charities to not turn down opportunities to benefit from those annuities. Just because they don't have a program. We can pretty easily create a program for them.
Great.
And help them say yes to those opportunities. And as you pointed out, it's a once in a lifetime for each giver. So they're going to find a charity to do it with, and then that's it. It's kind of a one bite at the apple sort of a thing, at least for now.
That's good to know. That's good to know that you're able to do that and have that separate entity that would qualify as the recipient under those QCD gifts using those split interest vehicles. What opportunities are there for family members to participate when they set up a donor advised fund? That's another question I get from clients. They want to have their children be part of the process, part of the legacy after they pass away. And with the private foundation, that's pretty easy to explain to clients. You know, you'll have your children as directors, trustees ongoing into the future, and they can make those grants to the charities. What about in the donor advised fund context? Is there any sort of legacy for children and grandchildren to continue and make grant recommendations on an ongoing basis?
There are, John, the advisors on a donor advised fund would be the givers. And then the succession plan that they outline can include successor advisors, and those could be their children. They can add, there's really almost an infinite number of possibilities, because they can include their children as successor advisors. They can outline the charities or the charitable, the types of charities that they want their kids to support, or they can leave it up to their kids' discretion. They can create some parameters around the time frame and amounts. So there's really, it's wide open, but there's definitely a way for them they can split their donor advice. If they have 3 children and they pass away with a donor advice, their fund has a balance, they can split that balance among the 3 children, and they can individually proceed with new funds. So the children can be making grants out of a new fund that followed their parents' passing, or they can be making grant requests out of the parents' fund.
Is that paperwork that's done internally with NCF, or is that something they should instruct through their estate plan themselves? How does that process?
It's done internally through NCF. There's an option for creating a succession plan, and whatever the option online in the donor advised fund program is fairly straightforward. If there's any additional instructions, those can be added.
That's convenient. I know that's a big issue for our clients at Miller Johnson, and from what I've seen, donors throughout the country in West Michigan, they really want to have that legacy, that spirit of giving and giving back to the community, to have those values instilled with their children and grandchildren. Is there a minimum amount that you require to set up a donor advised fund account with NCF?
No minimum.
And what about minimum payouts? I know, for example, with private foundations, there's that 5% payout. Is there a required payout that you have in terms of how much needs to go to the grant recipients?
We have a $100 minimum grant amount, but otherwise no. And there, I would say also, just kind of related to your question, donor advised funds, giving funds at NCF are also used as sort of testamentary landing spots.
Oh, good.
So folks in their trusts will identify their giving fund, their donor advised fund at NCF, as the recipient of some charitable intent, and then they can leave instructions with us for how they would want that to be distributed, or maybe if they want their kids to be successor advisors and distribute it, and maybe if they do identify their kids, maybe where they would like their kids to send that. There's lots of opportunities there, but that can be identified as a landing spot, and it gives a lot of flexibility, because on a year-to-year basis, if they change their minds about who they want to support, a charity goes out of business, or they become more involved with a different charity, it's really easy to change the instructions.
Well, I think it's comforting for clients and donors too. I have that situation arise often where someone may have significant assets, but don't have family. They don't have children. They may not have extended family. Maybe people have passed away, and they want to leave their legacy, their assets, to an organization that their values are going to be furthered and appreciated. And I see that quite often. And so for you to be a repository to receive those funds, I think is very comforting. And the ongoing administration, knowing that infrastructure is there. What is hard, I think, for clients, donors, is that uncertainty of not knowing who's going to be administering this money when I'm gone, and who do I name as a director, or if they're thinking of a private foundation, who do I name, and will they be there in perpetuity? And that's where I think the organization is a tremendous benefit, knowing that it's going to be there, that you'll administer those funds in perpetuity.
If I could speak to that legacy thing just a moment too, I'd just add, if somebody wants to have a fund with us that runs in perpetuity, I'd rather have them do it with us than somebody else. We're happy to do that. But we also really encourage people to give serious consideration to some sort of a sunset clause.
That's
Understanding that, a significant sum of money, we want to be handled deliberately with care. Spreading it out over some period of time makes sense, but forever is a really, really long time. And that question of who's going to be managing it and what will their values be and how will it be operating 100 years from now, 200 years from now, I think we've all seen more examples of that going badly than we've probably seen of it going well. And, we're happy to work with families too, whether they have kids or not, to perhaps put some thoughtful guidelines in place that says, hey, if this thing's not replenished by the next generation, then we want it spent down by at a certain date in the future. So the money is out doing the work that we know, and maybe even we knew the people who are going to be doing the distributions by the time we left this earth. And so I have found that to actually resonate a lot with families. Once they've had a chance to think it through, I find more of them bend towards some sort of a sunset clause than perpetuity. And
Jamie, what's the typical period? Will they say 25 years after I pass, 50 years? Is there or what would your recommendation be?
It depends a lot on the amount of money. I think the bigger the sum of money, the longer sometimes it might take for them to feel like it's been spread out appropriately and done right. It might depend on what assets are funding it. I mean, there are some estate plans we're involved in where, we could potentially be receiving some fairly complex assets. It may take a season for those things to liquidate. Maybe the kids will be buying them back from us if it's a part of an operating company. And we don't want to put the company in a position to have to cash flow too much too fast.
Mm-hmm.
That might take 25 years, or at least have the room for it to take 25 years if it needs to. Somebody might be leaving $5 million in cash, and depending on the extent of the causes they support and the size of those organizations and their ability to absorb the capital, it might be a 3-year or a 5-year or a 10-year spend down. So, I think we need to meet people where they're at, understand specifically what they're involved in, and then we can customize something to meet the moment and meet the specific need. But of particular interest to the charities who might be listening, and there's just an article in the Chronicle of Philanthropy that it was just really telling to me, and it was they did a pretty significant survey of high net worth families, and 80% of, we'll call them the Gen 1 interviewees, said they believed their kids were going to support the causes and the kinds of organizations that they had supported during their lifetime. They then interviewed Gen 2, and about 80% of them said, no, we won't. And so,
well, what about that? What I see in the foundation context, which they refer to as mission drift, there's been some high profile examples of designations that have been made with gifts to public charities that have not been adhered to. How can you protect your donors and assure them that there won't be mission drift? Or did they say these 5 charities for these specific designated purposes? How do you keep that or guide the family if they want to have multiple generations involved in the giving? Do you have a mission statement? Do you have parameters that you set down with the family that you work with to make sure that doesn't happen?
We can help facilitate a family conversation around giving strategy, and hopefully, while everybody's still alive, do a little discovery in terms of alignment and get a sense of how much alignment there already is around some things. And then on the succession side, if there's cause for it, we can put some parameters around things that allow the kids to be involved, but inside of predetermined parameters. So it might be these causes or these charities for this period of years. It might be these causes for this period of years. But you guys pick the charities. You guys keep an eye on what's going on. I mean, it could be as nuanced as, not more than X% of a capital campaign, or not more than X% of an operating budget. It can get as granular as they want it to. Not everybody wants to drill down that far and get that nuanced, but it is available if they want to. It could be bound by geography if they wanted to. So there's different ways to nuance it. Again, I think the better opportunity we have to do a little discovery with the family, get to know them, get to know where their heart is, the easier it is for us to actually implement a plan that reflects their wishes. And then to get that set down in writing, where ultimately, we're committed to seeing that through. But that said, anybody who says, I know what my organization is going to be doing 150 years from now, is not being fully honest.
Mm-hmm.
And so I could tell you everything NCF is doing to remain a distinctly Christian organization.
Mm-hmm.
And I have every reason to believe and hope that we will be who we are 50 years from now or 100 years from now. But if we're all being honest with each other, you're one board meeting away from being something different.
Mm-hmm.
And so it has really turned me into a fan of sunset clauses, of saying, set it unless it just doesn't make sense for some reason. At least give serious consideration to having a deployment plan that's going to take place within a generation or two from the time you leave this earth, because then you're probably going to know the people and know the values of those people who will be implementing that plan.
Mm-hmm.
And I think the risk of that significant mission drift goes way down.
That's a good point.
Fully understand that there are certain plans where, some sort of a perpetual life just really resonates with the givers, makes sense. We can do those things. And you just have to thoughtfully figure out succession and appointment of advisors and officers around those sorts of plans. But at the end of the day, you have to live with the risk that it will drift.
Yeah.
Because you cannot 100% control that.
That's a difficult issue to tackle. I think you're right. I think that sunset idea is a good one. I have seen it work on the other end as well. And I work with some foundations that are very old and have done some great work giving year after year to charities here in Grand Rapids. So, but it is hard to do. And I think you're right, especially with some of the challenges and issues we see today, differing philosophies and worldviews. I think that you're probably right. If you shorten that period, the likelihood that you're going to have an impact in the way in which you want to is going to increase. One last question, and I won't keep you, but what about investments? If a client or a donor comes to you and they want you to work with a particular investment manager, is that something that's going to cause an issue in terms of that irrevocable nature? Do you work with one investment manager? How are your funds managed there at NCF? And is there an investment portfolio or philosophy you have?
Well, we have a cash pool, but then we also have 5 traditional investment pools of sort of increasing exposure to risk, increasing holdings and equities. And we also have 5 faith-driven pools, similarly arrayed from not very risky to more exposure to risk. In addition, and so givers can allocate their fund balance among those different pools in different proportions. It just has to add up to 100%. Okay. And then if they have a balance that's greater than $300,000, then they can arrange for it to be separately managed. So their financial advisor essentially contracts with NCF to manage the balance in the fund alongside their own investments. Okay. There are some parameters, just general parameters around the types of investments that manager can make, but generally speaking, that's a popular option for folks with a higher fund balance.
Great. Well, I won't keep you. I just want to thank you both for joining me today and talking about donor advised funds, National Christian Foundation. I have enjoyed working with the two of you. I'd have to say, clients that we have here that have worked with NCF have been very pleased. And you, Jamie, in particular, I know we've worked on some matters, are very helpful in getting those gifts across the finish line. And sometimes with some tight parameters in terms of timing, year-end gifts, and some pretty complex stuff. So I appreciate your assistance. I know our M&A team also appreciates all that you do. So thank you both for joining us today.
I would say thank you for the kind words, and I would add that the more collaborative the relationship with the team of professionals around the client, the better it goes. And you guys are a treat to work with. So thanks for including us in this opportunity too, John.
Great. Thank you so much. Take care.